Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 121. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we have a packed week this week, Richard. But before we get going, quickly, we've had some feedback from YouTube viewers that they are being disrupted by adverts. Now, to be clear, we do not allow adverts. We don't participate in the YouTube program where we share revenue. We get nothing from adverts. And as far as we're concerned, you should not be receiving adverts. If anyone knows how we can prevent adverts appearing in these videos, please get in touch. Okay, news this week. Well, there was a lot of news. So in the oil market, OPEC Plus met, and Saudi Arabia announced that they would unilaterally cut their production by about 1 million barrels a day in July and extend it if necessary. Now, that would take their output down to about 9.5 million barrels a day compared to their reported capacity of about 12 million barrels. That caused a brief spike in oil prices, but it didn't last. And then yesterday, oil prices fell heavily on reports that the US and Iran had reached some sort of rapprochement, which would allow Iran to export. Those reports have since been denied. Elsewhere, Christine Lagarde has reiterated that the ECB intends to continue to raise interest rates until inflation returns towards its target level, and that is despite revised figures showing that the Eurozone entered a technical recession in Q1. We'll show you the chart later. China has asked its banks to reduce deposit rates to boost growth. We'll see if that's successful. And both the Royal Bank of Australia and the Royal Bank of Canada unexpectedly raised interest rates after a pause by 25 basis points each. So around the world, interest rates are still rising. The World Bank has raised its GDP growth forecasts for the world from 1.7% to 2.1% this year, and raised them for the EU and the US. But as before we go into the data, the big data was non-farm payrolls in the US, which came in hot, and the ISM services, which came in very weak. So once again, we're getting lots of contradictory data. So some charts related to the news. Well, this is Australian interest rates, and you see still rising. They skipped in March, but have since been raising steadily. There's a Canadian interest rate. They paused for 3 months and then raised again. And the market is now expecting them to continue raising. So you'll see here the inflation rates for Canada in blue and Australia in white. The US is in between. So Canada has raised rates despite having core inflation below that of the US. Does that mean that next week the Fed will raise? And the market is now pricing in an 87% chance that the Fed will raise again by July. There's a 37% chance they'll raise next week. And the market is expecting US interest rates to now stay above 5% for the rest of the year. That is a big change from earlier in the year. And Christine Lagarde has stated that she will raise interest rates further, and that is despite EU inflation expectations falling, as seen in the chart here. Reminder, over the coming weeks, US Treasury issuance will rise in order to refill the TGA account. Now, what is happening at the moment and why equity markets are doing okay is that the US Treasury is currently refilling the TGA by selling bills, and bills compete with the reverse repo facility. So that is liquidity neutral. So in coming months, it will have to sell longer dated treasuries, and that will drain liquidity. This is Saudi oil production, which is forecast to fall by 1 million barrels a day in July if they keep their word. But it caused a brief spike on Monday and then not much. And what's interesting is that Saudi Arabia is alone in cutting. In fact, the United Arab Emirates, a key ally of Saudi, has actually won a higher quota from 2024. Okay, and on to this week's economic data. Now, in the UK, car registrations remained incredibly strong, actually. So in May, they grew 16.7% year on year, beating expectations and up on April. Retail sales, though, slowed to 3.7%, down from April and below expectations. Construction continues to be mystifyingly strong, up slightly on April. But house prices in the UK fell for the first time in a decade in May, down 1%. Now, it also had announced by the FT the Indeed wage price growth number for May, and that rose to 7.2%. Now, the reason it rose is that in April, the new minimum wage regulations came in, and they mandated a 9.7% rise in the minimum wage, which is now being reflected in job adverts as seen on the Indeed website. And so that shows how in the UK we have regulatory inflation. So the government is essentially mandating higher inflation. In the EU, construction PMI came in soft. Below April and below expectations, retail sales were also soft. They were flat in April. Now, this week, we had the Caixin PMIs in China, and they were better than expected and directly contradict the NBS PMIs, which showed the Chinese economy weakening. So, who do you believe? Which one is more manipulated by the Chinese Communist Party? Now, I thought the next number was extraordinary. So, Chinese exports year on year in May massively missed expectations, coming in at minus 7.5% year on year compared to 8.5% in April. And if you think the difference between the two is 1 month's number, either you've got a big base effect or you've seen a massive deterioration in Chinese exports in May. Now, moving on to the US, well, the big number last Friday was non-farm payrolls, and that came in very hot. So the May number was 339,000 jobs created, up on April and massively beating expectations. Participation rate was flat. Hourly earnings met expectations, but was slightly down on April. Hours worked also fell. So we're getting two contradictory pieces of information there, in that jobs growth continues, but hours worked is falling, suggesting that factories and businesses have less work to do. You see, manufacturing payrolls have actually started to fall, but that has been more than offset by rising service jobs. Factory orders continue to fall, although at a slower pace than expected, and the Logistics Managers Index hit an all-time low for the third month in a row. So that really suggests that the US economy is slowing, certainly for goods demand. So the IBD TIPP Economic Optimism Index for June was very disappointing. So it was expected to bounce for May, but it bounced very slightly, much less than expectations. And finally, we had the ISM services PMIs, and they were very disappointing. And Richard will go through the data in a second. But if you look into it, the inventories rose, the order backlog fell sharply, and sentiment towards inventories rose sharply. So businesses think they have too much inventory, and that means they'll be cutting back on current activity. So you see there was a sharp drop in new orders, a sharp drop in employment, which seems again to contradict the rise in payrolls. The good news was that prices also fell. And finally, quarterly data, well, EU GDP in Q1 was revised down, and that means the EU has entered a technical recession. Richard, some charts.
Thank you, Keith. So this is the UK Halifax house prices month-on-month index. So we see the first drop, not the first drop, I beg your pardon, but we see a drop in April, and I think we're going to see more further drops. So year on year, 2022 is now negative year on year. The continuing pressure, I think, on mortgage rates is going to see that.
Yeah,
that persists for some time. Then the UK house price balance. What's that, Keith?
So the house price balance is the number of chartered surveyors reporting falling prices compared to the number reporting rising prices.
Yeah. So this is actually in accordance with what you'd expect. If house prices are falling generally, then you'd expect surveyors to be on the whole reporting falling prices, which they are. The UK Global Construction PMI, nice and steady really at around the mid-50s.
Yeah, actually surprisingly resilient.
Yep. And the UK retail sales, again, fairly resilient, not showing signs of distress by any means. So this is showing the advertised wages rising 7.2% year on year in May. And that pink line, it is pink, is showing an unpleasant upwards trend. The EU PPI month on month, quite a big fall. Seems to fall every third month, doesn't it?
Oh, yes.
A big fall every third month.
But that is good news. Producer price input inflation is falling.
Exactly, yeah. So the EU construction PMI looks like it's slowly falling, but not doing anything rapidly at the moment.
Yeah, but in solid contraction territory, where it's been for quite a long time now.
Yes. EU retail sales month on month unchanged in April. And year on year, gently declining.
Yeah.
Here we have EU quarter on quarter GDP growth, and we have 2 quarters of negative growth there. Hence a technical recession by a tiny margin, it has to be said. And EU GDP year on year heading towards zero, but on a year on year basis, still above zero. And EU PPI year on year. So EU PPI year on year is now fallen back down to effectively to zero. And the US unemployment rate is still, as far as the Fed is concerned, stubbornly low.
But, Richard, it rose in May, and this needs some explaining because the participation rate was flat, and according to the non-farm payrolls, we had 339,000 jobs created. So what's going on? Well, if you look at the household survey for May, it showed that there was a net 310,000 people losing their jobs in May. So it contradicted the non-farm payrolls and showed a net loss of employment. Now, what seems to be going on is that there are a lot of workers who are self-employed, and the difference between the two may be explained by self-employed people giving up and entering the formal work sector. So overall, although the formal sector saw job growth, the total economy saw job losses. But it's 1 month's worth of data, and not sure whether to believe the commentary, and the household survey data is very volatile.
So we have the US non-farm payroll figures for May, and it's showing broad employment growth across many sectors, most sectors of the economy. The Fed must be scratching their heads, mustn't they?
Yeah.
As we are. The US job market remaining tight with more job openings than unemployed. So, the jobs market is not indicating recession anytime soon.
But we know that employment is the last thing to roll over in a recession.
Yeah. And the household survey showed a 310,000 drop in the number of people employed, which is a contradictory survey, isn't it, Keith?
Yeah, absolutely. We're getting loads of contradictory data, basically.
So this is a repetition of the previous slide, isn't it? So this is it in graphical display. So this shows that the household survey data is very volatile, and we have to take that into account when we look at that last 1 month data point from the household survey. But according to this household survey, 412,000 unincorporated self-employed workers left the labour force in May, which is a big reduction, big number of people to leave.
Yeah.
And these will be one-man band businesses.
Yeah. So the commentary is it's people who are self-employed, like a self-employed gardener, giving up and getting a job in McDonald's. And
the self-employed as a percentage of the workforce has seen a very sharp drop in 2023, which is not very good news for the economy, actually, I would have said.
Yeah.
As a general observation, apart from the fact that clearly people are dropping out of that type of employment.
Yeah. So the headline non-farm payrolls got everyone excited about how resilient the US economy was. But when you dig into the numbers, it may not be all that it appears.
So US participation rate is continuing to climb after that post-COVID plummet, but it's still historically at a very low level.
Prime age people are now back in work at higher rates than pre-COVID, but we've lost older workers through long-term sickness or retirement.
And permanent layoffs have risen a little bit, staying low. So there's no indication or pressure on the labour market from that yet. And temporary employment is fairly stable, isn't it, Keith? It's not really moving very much either way.
Well, over the last year, if you look at it in aggregate, there's clearly been quite a large decline, but it ticked up in May. Yeah. And, we have talked about previously how the first indicator of a slowing jobs market is temps jobs, because they're the easiest people to fire. Well, last month, they were hiring.
Yeah. US average hourly earnings month on month, pretty stable. I mean, the big bar in April basically is only 0.1% higher than January, February, March, and May. And year on year, average hourly earnings just over 4% now, continuing to fall And the average weekly hours worked is also continuing to fall. But I would just put a caveat in here. The scale of this chart is really large.
Yeah, that's true. But, there has been some commentary that if you multiply the number of people in the workforce by hours worked, well, although non-farm payrolls rose last week, total hours worked by everyone actually declined.
Yeah. And the US manufacturing payrolls month on month showing a decline. And US private sector payrolls month on month showing quite a chunky increase. And government payrolls month on month, no sign of any pressure on government spending there.
Yeah, exactly. Amazingly strong. The US government, their fiscal largesse is contradicting the monetary policy by, supporting the economy.
And this tax tracking, calculating total withheld income tax, looks like it rose in May, which suggests that earnings in May went up, which suggests that employment is healthy. However,
Yeah.
US factory orders month on month increase, and excluding transport, they are in decline. ISM non-manufacturing survey data in May, Keith here has highlighted particular areas that inventories are growing, order backlogs are contracting, and inventory sentiment is too high. So basically, business does appear to be slowing down in non-manufacturing areas. This is the ISM services PMI, continuing to fall, now down to about 50.
Yeah, and that is a very weak number. It is an expansion, but if you look at it compared to its usual range, it's right in the bottom of its range.
Yeah. And ISM services employment is at pretty much unchanged 50. So neither expansion nor contraction there.
Yeah, but falling.
And ISM services business activity definitely looks like it's on a downward trend. And ISM services prices are falling, more competition in the sector. And ISM services new orders on a very spiky downtrend. Retail sales just continuing to decline, heading towards zero. And business optimism is not great, but it does appear to have stabilized. And the logistics managers index continuing to fall quite sharply.
Yeah.
So transport of goods around the country, US, is in decline.
Yeah, I included the commentary. This is its lowest reading in history. So if you're interested, pause, have a read.
US vehicle sales in millions, looking quite healthy.
Yeah, surprising.
And used car prices falling. And year-on-year used car prices not looking very healthy. There's a 30-year mortgage rate, which is up at around 7%. And the market index has stabilized really at this 200 level that it fell to quite sharply about 6 months ago.
Yeah.
They have the initial jobless claims, which has spiked up a little bit. And the continuing jobless claims on a little bit of a downtrend.
Yeah, there is a 1 week lag. Yeah. So the jobless claims are 1 week behind initial claims. Yeah. So last week's spike is not included in these numbers. We will see.
The trend of the last couple of years is really being followed this year in terms of initial claims. So there is no particular deviation from that. So it suggests things are quite stable currently. Yeah. And they're nowhere near recession. Jobless claims are nowhere near recessionary levels. This is the Chinese manufacturing PMI, which is moderately healthy, just above 50, looking stable. And the services PMI is doing well. There we have the composite PMI, which is also doing well.
Yeah, frankly, I just don't know whether to believe these. They're the NBS PMIs were the opposite.
Yeah.
So,
difficult to know, isn't it?
Some Chinese officials tapped them on the shoulder and said, oi, we don't like your numbers.
Yeah. China exports year on year appear to be dropping. And imports year on year are sort of stabilizing, I would say.
Yeah, but weak.
Yes. Chinese inflation doesn't really seem to exist.
Yep.
New vehicle sales in China, a little bit weak, but not too bad with comparatives.
Yeah, actually much weaker than expected.
Right, yeah.
And you can see if there's a trend in this, you'd say is not up.
Okay, so what's our summary? Seems like deja vu, really, doesn't it, Keith? Mixed jobs report, some beats, some suggesting things are strong, some suggesting things are weak. We've got a lot of unemployed people giving up work for themselves and possibly entering salary employment. We've got a very weak ISM service report. And so the US, it's certainly, I mean, I think it is still going to move into recession. It, generally speaking, is not showing great strength, but neither is it moving quickly into recession. In the EU, we had that technical recession after the revision of figures. And obviously, Christine Lagarde is keen to raise interest rates, which means the EU probably will go into a full-blown recession. And China's PMI is contracted. The Caijin PMI is contracted, whereas the NBS PMIs were showing continued expansion last week. So contradictory information coming out of China. And there's quite a lot of uncertainty around, isn't there, Keith, as to what is really going to happen.
Okay, thank you, Richard. And on to one chart. And this shows the change in spending on goods and services following a Fed rate hike, or the start of Fed rate hikes. And you can see it just takes a long time. Now, every week we take you through the data, and I think that the data in the US, despite continued strength in the jobs market, is slowing. We've seen that manufacturing PMIs have been weak for quite a long time now and are solidly negative. And the services PMI, well, May was a shocker. There was a reduction in the headline PMI, but when you look at new orders and inventories, new orders came down sharply and inventories rose sharply. And normally, companies respond to that by cutting employment. And I think employment should start to slow in the second half. And reminder, the Fed only started raising rates last April. So the big effect of those rate rises will come through with a big lag. And on to credit crisis watch. Now, regional banks in the US had a decent bounce last week following the markets up. We had a strong rise in US equities, particularly actually in the Russell 2000. So they seem to have taken the non-farm payrolls data very well. Now, bank deposits also rose strongly last week. But if we look at loan growth, well, it's weak and weakening. Commercial and industrial loan growth well down on 2022 and the median, and basically flat on the year. So the credit impulse is going to be very negative. Consumer loan growth actually pretty decent. Real estate loan growth actually not too bad. But corporate credit demand is very weak, as you'd expect. And when we look at commercial real estate, well, small banks in the US originate around 80% of commercial real estate loans, and they've already suffered big mark-to-market losses on securities they hold, as we have discussed in previous weeks, leading up to the failure of Silicon Valley Bank, etc. And distressed real estate assets are likely to cause them further losses over the coming months, leading to more concerns about the financial stability. And the federal bank term for lending facility by which they lend to small banks or any banks that need them in the US has seen more use. So there is still stress going on in US small banks. And we know that office prices and commercial real estate prices are continuing to weaken. So watch this space. The crisis in US small banks has not gone away. It is bubbling away there in the background. And if you look at commercial real estate activity, banks are tightening their loan standards, and there's very little demand for loans, as you would expect. And the exposure to commercial real estate is mainly small banks, some life insurers, and delinquency rates on CMBS office is rising sharply. And this is the percentage of CMBS loans that were interest only. And you'll see over the last decade, they have come to be the vast majority of loans. So that means that the borrowers are not paying off the principal. The only way the principal can be repaid is either by a sale or refinancing, both of which are more difficult now.
Or by a write-off.
Yeah, well, that's coming. And unsurprisingly, the price of BBB CMBS is falling rapidly. So the price you have to pay to refinance it is rising sharply. So expect losses when CMBS come up for refinancing. And defaults on leveraged loans are rising. Now, a leveraged loan is a loan made to a borrower who already has high levels of debt, and it's rising sharply. Expect it to get worse. And bankruptcies are also rising. These are bankruptcies of companies with more than $10 million in assets. Meanwhile, the Bank Term Funding Program, not lending facility, funding program, continues to get more use. Reminder, this is a very expensive form of funding for banks, which they turn to only if alternative sources of funding are not available. So banks are stressed. And this was my mental model of the financial crisis in the US, the small bank crisis. And we're in this period here where it's ticking away in the background. And when the when the CRE loans come to be refinanced, that will precipitate losses, and expect further bank failures. Richard, Inflation Watch.
Thank you, Keith. So there's no new data this week. And we have some charts for you. So this shows government spending versus the unemployment rate, and you can see the yellow blob is where we are today. So we are a long way from the sort of mean, the regressed line of where things have been previously. And what this suggests is that US fiscal policy is inappropriate, and it is too loose, and it is working against the Fed. So basically, as we discussed last week, the Fed is trying to tighten, and the US government is spending as much money as it possibly can.
Yeah, just silly. Fiscal deficit, 7% when you have unemployment rate of, close to its lows, actually close to its lowest ever numbers.
Yeah.
Insane.
I mean, the problem with that, of course, is the Fed will continue to raise interest rates to fight the fiscal pull in the opposite direction. As the Fed raises interest rates, it induces more damage in the real economy.
Yeah, no, of course.
So Liberty Street Economics estimates that underlying US inflation declined significantly in April.
Yeah, I think I don't know how they've done this. It's a multivariate regression, and I hope they're right. but they've deviated a long way from core PCE inflation in doing so.
Yeah, well, time will tell, won't it, Keith?
Yeah.
Fertilizer prices continuing to fall sharply, and so that should result in food prices falling. I mean, obviously, the prices can't fall until the farmer, the actual cost of the input has fallen.
Yeah.
And food prices should then follow agricultural commodities lower with a lag.
Yeah. We're looking at about a 1 year lag, which kind of makes sense. You need to harvest,
Yeah. The US market is expecting CPI to fall to around about 3% in June. Quite a big fall, actually. And the Cleveland Fed is forecasting June CPI at 3.33%, core at 5.1%.
Yeah, still too high. Core still too high.
Yeah. And this is the average hourly earnings growth, and you can see that really it hasn't peaked. It hasn't jumped up particularly.
Yeah.
And here we have the month-on-month change of the national rent index, which shows after a steep fall in the second half of 2022, rents are again rising. But year on year, they're up a tiny amount. Yeah, I mean, it suggests, I don't know what it suggests, actually. I think we have to watch this space on that one.
Yeah, and contradictory data.
Yeah. So the new tenant repeat rent index is now at 0, whatever that means.
Well, that means, if you sign up for a new 1 year lease or whatever, the year on year it's 0. And that directly contradicts the other data. So, who do you believe?
Yeah. So the ISM service prices generally sort of seems to lead the core PCE by about 6 months, which suggests core PCE should be falling to the mid-2s in a few months' time.
Yeah, but you see this correlation seems to have broken down recently.
Yeah, and it's not fantastic. It's a very spiky correlation, isn't it?
It is.
So wage growth is still at 6%, according to the Atlanta Fed wage growth tracker, which suggests that the actual there's still a lot of pressure, inflationary pressure in the system.
Wage growth inflation for job switchers is now declining sharply, and so your incentive to switch job is rapidly declining, which reflects a declining strength in the labour market.
This is the Indeed US wage growth, which is set at 5.3%, which is reasonably accurate. That will be on the basis of advertised jobs, advertised rates. And Bank of America deposit data shows that we have declining wages. Less money is being put into bank accounts.
Yeah, this is interesting. So, the advertised rates do not reflect what's actually happening.
US trueflation continuing its downward trend, and UK trueflation hopefully continuing its downward trend.
Yes. Well, let's wait until energy prices start to come off.
Yeah. So our summary here is inflation is falling. It's got further to fall, but we have elevated wage growth, which is actually going to make getting inflation down to target quite hard. There is some contradictory data suggesting that wage growth is moderating.
Yeah.
There's so much data around that there always seems to be contradictory data, I think.
Yeah, but I think we can say that inflation is certainly on a downward track. The question is, how persistent is core inflation going to be? And that's a function of wages. Now, the problem we've got in the UK is when you raise the minimum wage by 9.7%, you are mandating inflation. So what is the Bank of England going to do in 2 weeks' time? It meets on the 22nd.
Yeah. Very true.
Thank you, Richard. On to recession watch. Now, in the US, 35% of adults say they're worse off than they were 12 months ago. and only 54% of adults could afford a $2,000 emergency bill without having to either borrow or sell assets. So the average US consumer is financially quite fragile. And that suggests a lot of the pandemic stimulus has now been spent. And this is total household assets, and checkable deposits have come down from their peak. Now, how do you reconcile the two? That 54% of US adults can't afford a $2,000 emergency bill, but you've had this huge increase in checkable deposits over the last few years. Only if the rich have got a lot richer. And the question is, when will excess savings be spent? And they're clearly on a downward track and will be exhausted within the next couple of years. Now, some people think that there's 1.2 trillion left and it will take another year, and others think that it's pretty much gone. Not sure. But what's interesting is if you look at household spending, then if you exclude healthcare and housing, neither of which are really discretionary, spending on services less healthcare and housing, which is the black line, has basically been flat for a year. And returning once again to housing, houses in the US are increasingly unaffordable. So that should mean declining house sales, and that should slow the economy. But of course, we know that hasn't happened yet. Now, if we look at job postings in the US, you see big divergence between sectors. Some sectors doing well, the healthcare and anything IT-based doing very badly. If we look at non-farm payrolls, then the red line is manufacturing and the blue line is the service sector. Well, manufacturing jobs are now in decline. But how much can we trust the non-farm payrolls? Yeah. Essentially, the first release only has about 50% reporting rate. And we then have to wait for more data to come in, and often there are revisions. And the one thing we know is that non-farm payroll employment growth has been much stronger than would be expected from weak PMI readings. We've seen that services PMIs are fading and manufacturing PMIs are very weak. So how come we're still getting jobs growth? It's puzzling. Permanent job losses are rising, and whichever way you look at it, from an established survey or the household survey, jobs growth is trending down. Yeah. And EPB Research have a coincident employment index based on 5 labor market metrics, and that shows declining jobs growth. Still positive, but slowing. That indicates a recession is rapidly approaching. And the ISM employment index is deeply negative, whereas actual jobs growth is positive. So one way of interpreting this is that employers have overestimated their need for labor compared to their actual activity, which suggests they will soon start cutting jobs. And new data, haven't reported this before, it's the Kansas City Fed Labor Conditions Index, which is a national index based on national statistics. And it shows that the labor market is definitely slowing. And EPB Research put us in a slowdown, but not quite in recession. Auto debt delinquencies are rising. So that shows that poorer US consumers are clearly financially stressed, because the car is the last thing you default on. But weirdly, junk bond yields are showing little sign of distress. Something's got to give there. Now, falling US manufacturing means falling oil consumption in the US. So the dotted line is the ISM manufacturing index. The yellow line is distillate supplied. You see, falling oil consumption and falling electricity consumption, both of which are in the bottom half of their range. So further evidence from energy that manufacturing is not doing well. And globally, if we look at PMIs, pause, take a look. The blue lines are manufacturing PMIs everywhere, strongly negative. Red lines are services, which are more resilient. And frankly, we know services in the EU has weakened from there. And some data on global trade, all of which is negative. Take a look. Exports everywhere falling. And cardboard box shipments in the US confirm a goods slowdown. And the New York Fed supply chain index is at its lowest ever. So another piece of contradictory data. If the logistic management index is an all-time low and supply chains are very weak, how come heavyweight truck sales in the US continue to rise? It doesn't make any sense at all. And Goldman Sachs CapEx tracker is falling sharply. Now, the way we think a recession works is in interest rates rise, and that discourages investment. And the Goldman Sachs index shows exactly that. And the FIBER, Foundation for International Business and Economic Research, leading index is meant to lead other leading indices, and it shows that it thinks there's 100% probability of a US recession. Now, Prometheus Research, however, think that US recession will not start until early next year. And for now, US nominal GDP growth looks actually fine, but mainly thanks to inflation. Turning to the euro area, well, it's not looking good. The recent bounce in Eurozone economic activity is fading. And the economic surprise index, which I know Richard loves, is fading fast, back down to its lows. And if you look at new orders, Germany is the worst in the world. Global manufacturing PMIs look sick. And global leading indicators all look terrible. And that should mean inflation comes down. So in summary, the US consumer still seems to have savings from the pandemic, although it's unclear what the distribution of those savings are. And 54% of Americans say they would be unable to afford a $2,000 emergency. So it suggests that the poorer members of US society have all spent their pandemic stimulus checks. Global trade is in decline. Global manufacturing is in decline. The US labor market is slowing despite this month's strong non-farm payroll numbers, and US services is also slowing. Everywhere, it looks like the normal fade into a recession. And now on to US construction. Richard.
As you know, we've been talking for a while about why the US construction sector is remaining so strong. And with some charts here which suggest an answer to that. Basically, the Inflation Reduction Act and the CHIPS Act have put vast sums of money via subsidies into the US economy for reshoring and for development of, particularly development of environmentally friendly energy. And what this has resulted in is a huge surge in manufacturing construction. So spending on, you can see the chart shows the spending in on climate change has gone up, what, tenfold probably in the since the decade, the 2000 to 2010 decade. And they're putting around about $600 billion into these two things. There's many green energy subsidies available, which are incentivizing energy infrastructure projects, and anything that's infrastructure is going into the construction data. So we've got all of these: carbon capture, green hydrogen, utility solar, onshore wind, battery storage, homes efficiency, residential solar, offshore wind. And presumably where it says new EV purchases, we're talking about new plant to produce EVs, or certainly new plant to produce EV batteries and motors and so forth.
Actually, I think those might be subsidies just for buying a Tesla.
Okay, yeah. So, and that's going to then go to feed into factories required to produce the components of green electric vehicles. This is then reflected in the manufacturing infrastructure spending. So if someone is reshoring chip manufacture from Taiwan, for example, the cost of that is in the many billions of dollars. And you multiply that by multiple times, and you get this huge surge in US manufacturing spending, which is effectively all being subsidized by the US government debt. But nevertheless, it's having a huge real economic impact. The majority of new spending is on computer, electrical, and electronic, which is effectively semiconductor manufacturing. And you can see there's a little bit of an increase in food, beverage, and tobacco, and a little bit of an increase in transportation. But effectively, the other sectors aren't growing. So the vast majority of it is semiconductor manufacturing. And these fab plants are very expensive. So manufacturing construction, enough to keep the total construction spending rising, whereas residential spending, as you can see, is actually falling as we predicted. And will probably continue to fall, I think, given the current mortgage rates. But obviously, manufacturing expenditure is going to continue to rise.
Yeah, but you would suspect it's a one-off surge. And also, I really question whether what they're doing will create lasting wealth. So, we talked last week about the Total building this green hydrogen plant to produce methane in Texas. Just seems absolutely insane. So natural gas prices in the US are towards their lows. And then you're investing huge amounts of money to produce green hydrogen, so green methane from hydrogen produced from solar. It just seems absurd.
Basically, it's tax policy driving manufacturing policy, isn't it? Manufacturing decisions, investment decisions are being driven by tax policy. Yeah, that can be happening. So, I mean, it will peak. I don't know where it will peak actually, but at some point, probably as you say, Keith, fairly soon this will peak. So again, we're just seeing that manufacturing construction is growing incredibly rapidly, and it is because of the CHIPS Act and the Inflation Reduction Act, incentivizing massive manufacturing infrastructure spend. And as we said, it's more than offset the slowdown in residential construction spend. And this is a chart which just shows that mentions of reshoring in company reports and company calls is skyrocketing, which means money is being invested in reshoring. So strengthening of supply chains or shortening of supply chains. So given that manufacturing PMIs are weakening, what's going to be the upshot of all of this? It's really quite interesting. They're spending a great deal of money on developing new facilities, but there's a general slowdown in manufacturing. So difficult to know how it's all going to come out in the wash.
Yeah.
Surplus capacity, anyone?
Well, exactly. Things like the green methane just seems ridiculous.
Yeah. So this is showing that the expenditure on manufacturing construction is continuing to rise from April 22 to March 23 to April 23. So it's still going up. As we said, at some point, that will decline. Peak. And it'll probably decline quite fast once it hits that peak. So this is the iShares US home building ETF, which is back to its all-time highs.
Yeah, you see, the US equity market has been absolutely mystifying this year. And this is, to me, just seems peak stupidity. I mean, how do you explain this?
I can't. I mean, it's just bizarre, isn't it? But as you say, the US equity market doesn't appear to be following any logic to you or I.
Yeah. And you look at these metrics on the US house building sector, and that rise in share prices is all due to changes in the PE ratio. Actual earnings are well down on last year. So just absurd.
It's speculation, isn't it? And the market has basically been taken over by speculation. And the current speculation is we're going to recession, the Fed will start QE again, and the stock market will go to the moon. I mean, maybe it will do.
Yeah.
And question, is manufacturing construction enough to prevent a recession? Well, probably not, particularly as it isn't going to go in that parabolic line forever. It's going to stop.
Yeah.
And I suspect it's going to come to a shuddering halt. So 33.4% of US homes were bought with cash in April, because basically the cash buyer is king now, doesn't have to take out a loan at 7%, as we saw earlier.
Yeah. So how long can this last? Because we know mortgage rates, but, it's a mortgage market index. So the number of people taking out a mortgage is really low.
Yeah. Yeah, good point. So there we are. US construction activity is strong because of government stimulus, which is temporary, but which is also extremely powerful at the moment. And it's still growing. It will grow until the subsidies have been spent, and then it will stop growing. In fact, then it will contract very rapidly, in my view. And residential construction expenditure is slowing, as we have expected.
So on to, are we going to have a soft landing? Well, Goldman Sachs thinks we are. So Goldman Sachs thinks there's only a 25% of a US recession this year, because the jobs market is normalizing with few signs of a contraction. If you look at the quit rate by historic standards, that seems fine. And the job openings relative to unemployed people remains very healthy. And the current market data seems to be indicating the US economy is doing just fine. Thank you very much. So Goldman Sachs estimates that it's currently just above 2%. And if we look at the Atlanta Fed, it agrees. So the US economy seems to be doing just fine, but I'll be interested in Richard's thoughts on this as well. Monetary policy acts with a lag. The manufacturing sector is in recession. The service PMIs for May were awful and indicate that the service sector, having bounced in the first quarter, is now slowing. And as far as I can see, monetary policy acts with a lag, and seems like a normal economic slowdown. And it's just a question of time, but I think we go into recession. Your thoughts, Richard?
Yeah, I agree, Keith. And I think things are slowly moving, very, very slowly moving in that direction. What actually quite concerns me is this manufacturing construction information that you have gleaned, because when the subsidies stop, the construction spend will stop. And when that construction spend stops, and where would the US economy be without that construction spend now? So if policy is based on the subsidies, the subsidized manufacturing expenditure being genuine, in inverted commas.
Mm.
When that stops, you get a double whammy of a much tighter policy and a sudden cliff edge in manufacturing, manufacturing construction.
Yeah, no, I agree. I mean, Biden is running pro-cyclical fiscal policy. It's idiotic.
Yeah. And the Fed will be fighting to tighten rates because of this spend. And then effectively one will fall away and the other one will be much too tight.
Yep, that's right. A brief aside from me. So I disappeared down an internet rabbit hole this week, and we've talked about this before, but the Three Gorges Dam in China is by far the biggest dam in the world, and it's a gravity dam. Okay, so a gravity dam means that the dam is held in place just by its own weight. Okay. And when there were floods in 2020, the dam shifted. Now, one thing,
because if you go back to those pictures, Keith, the second picture, it's all wobbly.
Yeah, exactly.
Wow.
Now, one thing I didn't realize is that when concrete sets, it's a chemical reaction capturing carbon dioxide from the air to form calcium carbonate, a limestone, and it gives off a lot of heat. Now, when the Hoover Dam was built, they controlled the rate at which the concrete sets, and bear in mind, these are huge concrete structures, by lacing the structure with 582 cooling pipes and building an ice factory next door to produce 1,000 tons of ice a day. They would then pump cold water through the concrete structure as it's set to control the rate at which the concrete set and get even concrete setting. Because one of the things about concrete is there's a feedback loop. As it heats up, it sets faster, and then you get more heat.
As a little aside here, Keith, which is a cautionary tale to anybody who does the same thing, I was mixing resin a while ago, and resin also produces heat as an exothermic reaction when you mix the hardener with the resin. And the hotter it gets, the quicker it cures. The quicker it cures, the more heat it produces. And I had it in a cardboard coffee cup I was mixing. It wasn't a vast quantity. And I actually set fire to the cardboard coffee cup.
Wow.
I wasn't watching it. I was distracted. I went away for a while. I came back and the heat had set fire to it. So it's extraordinary because it's a self-accelerating reaction.
Yeah, absolutely. So in China, the original plan was that they were going to do the same thing as the Americans have done when building the Hoover Dam. Bear in mind, the Hoover Dam was built in the 30s. And so you've had, 80 years of technology growth in between. And they didn't do that because they wanted to set the world record for pouring concrete, which they did. And so you can see this is how the Chinese Communist Party works. They basically said, no, don't do it safely, do it quickly, because we want to, grab the headlines. And so as a result, inspections of the Three Gorges Dam, as it was being built, raised concerns about the quality of the concrete. If the concrete sets too quickly, then you get differential setting rates and you get cracks forming, and cracks are not good in a dam. And if the heat rises sufficiently, you actually get bubbles forming. And cavities were found in parts of the shiplock. Now, what does that mean? Well, the danger is that if there are floods, then the Three Gorges Dam could fail. And the other thing about Three Gorges Dam is it's changed the local environment because you've got this huge standing body of water now. And so they've found that there are more frequent heavy rains.
Really?
So if the dam bursts, 400 million people are living downstream.
Oof.
Just putting it out there. Some other charts, Richard.
Thank you, Keith. So we've discussed this before, but we have a high proportion of UK short-dated mortgages. In other words, the fixed rate falls off and people then have to refix at whatever the rate is going to be. And we are amongst the highest rate, amongst the highest level of short-term fixed rate mortgages, 1 to 5 years. And we know that a lot of these are facing refinancing in the next 12 months.
Mm.
The consequence of that is that, as we mentioned some time back, people's interest rates are going to go up from maybe 1 or 2% to 4 or 5%. And that is going to remove a huge amount of disposable income from the UK economy and put it into the hands of the banks and building societies, clearly, and the lenders. But the problem is the amount of disposable income that's going to be swept out of the economy over the next 12 months or so with this refinancing of mortgages have quite a dramatic adverse effect on the economy.
So turning to China, well, we saw the Caixin PMIs portrayed a strengthening Chinese economy, but all the other data we see shows that the Chinese economy appears to be weakening. Pause and take a look. Loan growth is very weak. Industrial production, very weak. We know exports were incredibly weak. And new housing starts year on year, terrible. And if you look at the economic surprise index for China, it is also poor. And I thought this was a recipe for social unrest. Employment falling, was a number of graduates coming out of Chinese universities is rising. And so we reported last week the big rise in Chinese youth unemployment. Well, that's not good. But contradicting all that, if the Chinese economy is doing so badly, how come commodity imports were strong in May? Pause, take a look. You'll see, copper imports rose sharply, gas imports rose sharply, soybean imports rose sharply. Getting lots of contradictory data. And on some good news. Well, this is China's CO2 emissions forecast. And I don't know how much to believe this, but they are on path for 0 in 2050. And we know they're building vast numbers of solar panels. Do we really believe they're going to give up on coal and there's going to be this huge rapid drop in coal consumption in China so that they get to net zero? Well, Bloomberg seems to believe that China's CO2 emissions have now peaked and will start to come down rapidly. And if that's true, that is fantastic news. And on to equities, Richard.
Thank you, Keith. So not a very sparkling week in any direction, particularly for equities. And so the FTSE sort of bumping around, no change for the year. The stocks Europe actually up 8.5% now for the year, which is reasonable. The S&P and NASDAQ we've discussed, and you see that discussed everywhere. There's this overarching influence of the tech shares, and if you take those out, effectively nothing very much is happening in the S&P and the NASDAQ. They're having an outsized influence. The Hang Seng up a bit, almost unchanged year to date. Topics is doing very well, up another 2%, 17% year to date. Bitcoin down a little bit, but still up 6. Bitcoin down a little bit, but still up 6% year to date. The pound against the dollar is up nearly 4% year to date, whereas the euro is pretty much unchanged against the dollar year to date. and the dollar index is unchanged year to date. So there's been a lot of smoke and noise about the dollar index, but actually it's unchanged in the last 5 months. And the VIX fell another 12% last week. Is this a dangerous signal? One wonders.
Yeah, just seems signal. Yeah.
So the only things that are up in the year on year is the US large caps and cash.
Yeah, this makes me feel better actually. It's been extraordinarily difficult to make money this year unless you're either in cash or the NASDAQ.
Yeah. Who would have thought the NASDAQ, eh?
Well, no, but talking about that for a second, Richard, you've had rapid rises in interest rates, and tech companies were meant to be highly sensitive to interest rates because you're discounting future revenues by a higher discount rate. And instead, they've shot through the roof. Yeah. This market just defies common sense.
It does, doesn't it? Completely agree. It's a bit like the people are buying the last bull market success stories.
Yeah.
Now, I wouldn't put my money where my mouth is either way because I don't understand really what's going on, but it doesn't feel right to me. So we have on the greed fear measure, we have extreme greed. We're just inched into extreme greed. And I actually think extreme greed should be red and extreme fear should be green.
Yes, good point.
Current versus prior bear markets in the S&P 500 with a thick black line, and really we're not in a bear market if you look at that. So it's not behaving according to plan.
No, mystifying.
And as we just saw, greed is back. The Russell 2000 index has surged 7% in 7 days.
Yeah, and actually talking about this, so this is US small companies. We know that manufacturing PMIs are terrible, that services fell sharply in May. So how come, small US companies are going up? It just, the whole thing doesn't make any sense.
And interest rates are expected to rise.
Yep.
So after all S&P 500 companies reported earnings, sales per share growth was 9.1%. Pretty good. S&P 500 earnings per share growth was 6%. And 12-month forward earnings forecasts are rising once again in Europe and the US, which is a bit odd given that Europe's probably going to is entering a recession.
Yeah, I think Europe is in a recession.
Never mind the US. So global trade as measured by South Korean exports is down. We, of course, have to counter that with what's going on with reshoring in the US. But probably it's too soon to have had much of an impact. And the S&P 500 typically falls around 5%, following a $500 billion outflow from the banking system. Basically, all the previous indicators of what the S&P should do no longer work.
Yeah, that's right. It basically seems to be driven by liquidity.
Yeah. So the NASDAQ 100 is soaring to a record high against the Russell 2000.
Yeah.
AI. And it looks overbought, doesn't it?
Yeah. It's just insanity.
Indeed. I completely agree.
I was listening, sorry, before you go on, Richard, I was listening to a podcast during the week. We were talking about, NVIDIA's on 37 times revenue, and once again, somebody was reading out the quote from the guy from Sun Microsystems about 10 times revenue after the dot-com boom, saying, what on earth were you thinking buying the shares in Sun Microsystems at 10 times revenue? When in order to get your money back, he needs to give you every penny the company makes for 10 years, excluding, all the costs, all the taxes, etc., etc. Yeah. It's just absolutely idiotic. And then NVIDIA's on 37.
Yeah. And and exactly. And a multiple, I don't know what the earnings multiple is, 300-ish, something like that.
Yeah.
So and record weekly inflows into tech. I mean, good luck to them. I can't help feeling it's all going to end in a rather nasty jolt of reality.
Yeah.
And selling energy to biotech. Well, that's interesting, isn't it, Keith?
Mm.
And the only growth and high beta stocks are up year on year. All the rest of them are down year on year.
Yeah, again, really interesting. You'd think in a rising interest rate environment, value stocks would outperform.
So if this is a bear market bottom even, stocks are incredibly expensive. I mean, it's not a bear market bottom, is it? It's a, I don't know what it is, but it's not that. The world is, I mean, also there's so much debt. Sorry, you have to cut this, Keith. I'm becoming incoherent, but basically I can't explain it. It doesn't make any sense to me.
Yeah, well, the thing is the S&P is apparently up 20% from its recent low, which means bull market's back. But, it just seems totally illogical.
Yeah. So the S&P 500, typical performance of the S&P 500 in a year, typical performance of the VIX. So if typical performance is anything to go by, which we've just suggested it's not,
yeah,
the VIX is going to rise over the next few months.
Yes, that's right. Okay, thanks, Richard. On to commodities and energy commodities. And it was a mixed week. So despite all the news about OPEC Plus meeting, etc., oil was pretty much unchanged on the week. Brent was up 0.8, WTI 0.1. Both are still well down on the year. We had a big bounce in European and British natural gas prices, although they're still down 65% on the year. Coal also had a bounce, up best part of 5%, still down a lot on the year, down 65%, and uranium was flat. Now, if we turn to numbers specific to the oil market, interesting, we had a big build in the US. So excluding the SPR, we had a build of almost 11 million barrels, and that suggests the US oil market is well supplied. Total US crude production unexpectedly rose 200,000 barrels a day last week to a new recent high of 12.4. But the Baker Hughes rig count continues to fall, and those are significant falls, down 10% on the year. So this is crude, volatile, but the OPEC Plus cuts have failed to lift it significantly. Now, last week, we showed you this chart, which was US gasoline demand, which is down between 3 and 12% on pre-COVID levels, depending on which data set you use. And I said at the time, it was probably due to electric vehicles. Well, a YouTube viewer, AP, got in touch, and he points out it is much more likely to be because of lower commuter traffic. And once he pointed that out, yes, it's obvious. So thank you, AP. Now, today, the UK government has set the criteria by which it will cease the windfall tax. So the windfall tax currently means that North Sea oil producers are paying 75% tax rate, compared to a previous rate of 40%. And once oil prices go below $71.4 a barrel for 2 consecutive quarters, then windfall tax will revert to previous levels. These are EU natural gas prices. Turning to the UK, Investec are predicting that UK domestic gas prices will remain well above pre-invasion levels until 2026. So the blue line is the energy price guarantee, and the bars are the expected UK domestic gas prices. And you'll see they are going to come down very sharply in the coming quarters, but they will settle at levels well above pre-invasion, as you would expect, frankly, as we are now importing expensive LNG. And forward electricity prices reflect that reality. Turning to the US, this are US natural gas prices. Again, they had a bounce, but from very low levels. Coal, well down on the year, although it bounced slightly this week. Uranium, continuing to rise. And Cuppy, those of you who listen to the Market Huddle will know Cuppy, he has gone all in on uranium. Richard.
Interesting. Good for him.
Yeah.
When does he think it's going to pay off?
Don't know. He's saying that there's a shortage, and one US nuclear reactor had to buy some, and that caused a spike in the price. Therefore, if lots of them have to start restocking, then the uranium price goes through the roof.
There's also some rules about they're not allowed to source it from, well, obviously not allowed to source it from Russia, but I think the Inflation, well, I don't know which act it was, but I think they've introduced rules that it has to be sourced, specifying where it cannot be sourced from.
Right.
Which means that global supply is not, as far as the US is concerned, global supply is not global supply.
Got you.
So looking at industrial commodities, aluminium down a little bit weak. Cobalt has steadied. Copper is up a little bit. I mean, you would think, wouldn't you, that there'd be a massive demand for some of these commodities down in the US with all of that
Yes.
manufacturing, construction. Chromium unmoved. Iron ore up 7.2% was a big move on the week. Lithium carbonate unmoved, but the price seems to have stabilized there. Neodymium oxide up 1.7%. Nickel, not really much move on the week, but 30% down on the year. Tin, basically moving around about 2 to 4% up for the year. And ferrovanadium, not really having a very good time of it, is it? It's down 14% for the year, 1%. And zinc, a little bit of a bounce, but still 19% down on the year. So we have aluminium and cobalt, copper, chromium, iron ore, lithium, neodymium, nickel, tin, ferrovanadium, zinc. So just moving on to precious metals. Gold not moved very much on the week and up nearly 8% for the year. Silver had a bit of a better week. Platinum down 5% on the year, but a little bit up on the week. Rhodium continuing its rather precipitous drop, now down another 7% and halved in the year to date. And palladium not being very happy either, down nearly 25% year to date. So there we have gold, not very far off its all-time highs still. Silver, platinum, rhodium, palladium.
Yeah, the catalytic precious metals are really collapsing. You do wonder whether that is because of the impact of electric vehicles.
Yeah, definitely. Clearly, demand has fallen away.
Yeah. Okay, thank you, Richard. On to rates, and rates continued to rise last week, but more slowly. So UK 1 year is now at 4.75%, and that basically means the market is expecting the Bank of England to raise by at least one more 25 basis point rise and then keep it there for a whole year. And the whole curve rose. In Eurozone, we also had rises. Italian 10-year rising by 20 basis points, and the Italian 10-year is below the UK 10-year. Now, if you look at five-year forwards in the US, then they show no sign of worrying about long-term inflation. The Fed still retains its credibility. And given global PMIs, you would expect inflation to come down and then the 10-year bond yield to come down. That's basically what I'm betting on. It's the UK 2-year, not looking good. 10-year, not looking good. 30-year, maybe that's stabilizing. US 10-year, not great. German bond yield at 2.4%. It wasn't so long ago. That was at 0. Italian 10-year at 4.2. Greek, surprisingly, coming down well below the Italian one. Any change to your views, Richard?
No change to my views this week, I think, Keith. It's, still sticking with what I've said previously.
Okay, so concluding comments. Well, global manufacturing is in recession. US services, as based on the ISM, is slowing. And in particular, there was a big drop in new orders and a big rise in inventories. Bankruptcies and defaults in the US are rising. Interest rates everywhere are still rising. So, as far as I can see, this is the normal backdrop to a recession. And I'm still expecting a recession in the second half. And frankly, the ISM numbers made me more confident in that call. So the question then is, why are equities so strong given the weakening economy? And we have analysts raising their earnings forecasts, and that just seems delusional. So, Richard, what did you get up to this week?
So I'm afraid that one on. So as is my normal position, Keith, I haven't done anything this week. I haven't done anything last week. I've done virtually nothing all year. The asset value has changed very slightly, but it hasn't changed to any significant degree. There doesn't seem much point in presenting a slideshow of nothing. So really, I'm in precious metals. I have some uranium. I have some industrial metals, and particularly related to the electrification of the world. And I am sitting on my hands and not doing anything. And when that changes, I'll tell you, obviously, but I'm playing a waiting game. I'm being very patient, and I'm hoping that my patience will pay off in due course.
Well, you've been very wise so far, Richard. I had a slightly better week, but I'm still having a very poor year.
Good.
Now, one thing that viewers will have clocked is that UK yields actually rose this week. So how come my huge bond position actually had a positive return? I don't know, actually. We've some contradictory data. We get the yields from Market Watch, but the actual prices of long-dated UK gilts rose last week. So therefore, yields should have fallen. So I did some activity. I sold some short-dated gilts and I added to my position because, you know, if you look at the, I think you've got to be brave. And frankly, I looked at the ISM services and the economy is weakening. And I reiterate my call for a recession in the second half. And I just think that everything shows that central banks continue to raise interest rates, and that will slow the economy with a lag.
Yep, I completely agree.
So, hurricane energy. Long-term viewers will know I did a my worst trade on this particular disaster. And this week, it disappeared from the stock market. It was taken over, which provides long-suffering shareholders with some sort of relief. If you haven't watched the My Worst Trade on Hurricane Energy, please do so. So this is TR24. Now, which is the 2024 index-linked gilt. Now, talked about this before, but the price has been falling because interest rate expectations over the next year have been rising. But I still made money on my investment in TR24 because you get inflation, and inflation has been strong. If you hold TR24 over the next 3 months, you can make about 4% just on the indexation. And this is T44, which is the 2044 index-linked gilt, and that yields about 1% plus inflation, plus RPI inflation until 2030. So, I may have suffered some mark-to-market losses, but, over the course of the next year, I'll probably make about 8% on this. And this is T68, which is 2068 gilt and has a lot of risk, and, used to be at 320 at its peak. So it's well off its lows, but, it could go anywhere. And if you hold this, you have to be willing to accept losses, and, it hasn't been fun. But I still expect inflation to come down, and that when the UK and the US goes into recession, then the Fed and Bank of England will cut rates hard. Okay, thank you very much for watching. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.